Good evening, ladies and gentlemen. We can just settle down, please. I know long sessions, and thank you for being here on a weekend, giving us the opportunity to share our thoughts, our views on what's happening on the market and the way forward. So my job is very simple, thanks to some of the veterans who have taken some sessions earlier. So Ankit spoke about where to invest, and we all know which is the best asset class to invest in, which happens to be India today. So I come from Motilal Oswal, where my founder Ramdevji believes there is only one asset class, which is equities, and he believes that India is the only shining star in today's day and age, where long-term compounding can see markets give you phenomenally high opportunities for wealth creation. In every conversation that he has, he mentions how he started his journey about 35 years back when Sensex was around 100. Today we all know it's around 84, 85,000. I started my career about 25 years back, just around the dot-com bust, when Nifty, to everybody's surprise, was around 1100 points. After that, we had the global financial crisis in 2007-8. We had the currency crisis. We had the taper tantrum in 12-13. Of course, you had the demon in 2016, followed by the IL&FS crisis in 2017. And then in recent times, we had the COVID. Despite all these terrible things or events that have played out in the last 15-20 years, the markets, like Ashish mentioned earlier, has been compounding at around 14 to 15%. And this, our view and our conviction is that this will continue to grow for the next 25-30 years. So essentially, one of the most easiest way to look at your money doubling every 5 years is to be in India. While Ankit spoke about where, Ashish spoke about how in terms of asset allocation, I'm here to speak about a very, very difficult topic, and one which is very, very pertinent is when to invest. So if you ask my founders, Ramdevji, he'll say now and forever be invested, right? But of course, things are different for different people. Ankit and team will take you through various asset allocation plans, and he will draw out a plan for you in terms of where to invest, when to invest. I'm here to just give you some thoughts about why we think you don't have to really look at timing the market. I'm sure most of you have heard this time and again, that it is time in the market and not timing the market, which actually makes money for you. So with that, I'll probably skip some of these slides which have already been covered and straight away go to valuations. While yes, markets have corrected over the last almost a year now, since September of last year, markets have remained more or less flat. In the last 1 year, Nifty returns are roughly around 2 to 3%, whereas the earnings have grown by about 8% for the Nifty companies, right? So in terms of valuation, does pointer work? Thanks. Sorry. Anyway, so essentially what we are seeing is this is a chart which tells you one particular number of looking at market valuations. So if you see here, the first one is of course of the Nifty 50, which is the top 50 companies of the country, where compared to the historical average, the current PE of 21 times is roughly almost near the long-term average. But if you see, one of the most often asked question is in terms of valuation for the small caps and the mid caps. So from this chart, if you just look at the number optically, it looks that the mid cap stocks or the mid cap index and the small cap index looks very, very expensive compared to the long-term averages. We have a small disagreement to this one number, because in any investment, any decision that you take in life, it is not about taking a decision based on one data point. You have to look at various data points, you have to look at various angles and then take a decision. We have done a small chart here, slightly complicated, so just bear with me on this. But if you see the first number, again, I'm sorry, if you see the first one, it talks about a company which is growing at 16%. Every year, let's say 100 rupees gives you 16, 16, 16. At the end of the 10th year, it gives you 1100 rupees. But if the company were to grow at just 15%, 1% lower for the next 10 years, the valuation actually drops by about 5%. So just inverse this. If a company growing at 15% suddenly starts growing at 1% extra, 16% for the next 10 years, your valuation can be 5% higher. And that is what we saw in the last 4-5 years since COVID. A lot of these small cap companies, a lot of these small cap indexes have grown at about 35 to 40%. And it is our belief that it will continue to grow at that healthy clip, because a lot of these new sectors which are emerging, which were not there earlier, are today great opportunities for us to make money. How many of you thought about investing into defense companies 5 years back? Maybe 1 in 1,000, right? How many of you looked at investing into electronic manufacturing companies about 5 years back? There were no companies. How many of you looked at hospitals to invest? There was only one company, which was Apollo Hospital. Of course, we had some pharma companies. How many of us invested in renewable power? Of course, all investors invested in Suzlon way back in 2006-07, and then there's a big debacle. But today, the point that I want to make here is that over the last 3-4 years, there have been a lot of new sectors which have emerged. And these are the sectors which are likely to grow at earnings which are far, far, far higher than what we saw in terms of the headline number. So I'll just maybe skip some of these slides, and this is what we believe are some of the sectors where Motilal Oswal as a company is investing into. So for example, one of the biggest themes that we are looking at is this whole China plus one Make in India theme. Ankit spoke about a lot of reforms that has been started by the government of India, especially the PLI, the production linked incentive. The government wants to give a lot of boost to manufacturing in India. They want to give boost to exports, because exports end of the day also generates a lot of employment. It also adds to the growth of the GDP. So one of the biggest beneficiaries of the PLI scheme has been the electronic manufacturing services. And Ankit again gave you the number of Apple phones being manufactured in India. Last year we exported close to about 150 million phones, right? So today big brands like Apple phones are being made in India. Google Pixel is being made in India. And you'll be surprised, a lot of these Chinese phones like a Oppo or a Vivo or a Realme or a Xiaomi are also being made in India. Very soon we'll also be making some of these tabs and some of these phones for a lot of other companies also. So that has been the biggest beneficiary of the government's production linked incentive. And we have a lot of examples in our portfolios and in some of the stocks that you have invested into, which have really benefited from them. Second one, of course, is your entire renewable power. Like I mentioned, a couple of years back, there was only one company, Suzlon. A lot of us invested in that company. Of course, it had a very, very bad cycle since global financial crisis. But today, it is the government's stated intent that by 2030, 30% of all the power generated in the country has to be from cleaner, greener source. So the clean, green source of energy comes from nuclear or wind or solar. Nuclear, you don't really go hammer and tong behind it, because it has got its inherent safety hazards. You don't have too many private sector companies in which you can invest and make money from. But a lot of companies on the wind and the solar side are actually really benefiting from the structural change that the government of India is bringing by investing into some of this renewable power. The third biggest sector, which all of us are really benefiting from, is financialization of savings, right? And I'll give you a small example of that in this particular chart here. Sorry for that. Yeah. Look at this number. So over the last 25 years, our total savings pool in India was roughly around $12 billion. In the next 25 years, trillion dollars. In the next 25 years, this will go to $103 trillion. I don't even know how many zeros will come if I convert it. Because post-COVID, what has really happened is, people are moving money out of bank deposits, land bank and gold, getting into mutual funds, getting into capital markets. You're seeing a lot of numbers being thrown at you. Number of demat accounts grown from 2 crores to about 19 crore. Mutual fund numbers, SIP book is almost $2.5 billion per month. The entire industry, in fact, I started the industry when the entire mutual fund industry was roughly around 5 lakh crore. Today we're about 70-75 lakh crore. And look at what has happened because of that. So over the last 2 years, FIIs have been negative in the Indian market by about $4 billion. You and me, through our SIPs, through our mutual funds, through our investments in the stock markets, have contributed almost $102 billion. And this is the biggest cushion for the Indian markets. Now, if I were to combine this to what may happen over the next 25 years, Imagine the opportunity that you will have to make money from some of these beneficiaries of this financialization of savings, which is essentially money moving away from traditional bank deposits, land and gold coming into capital markets. So that is the biggest, one of the other themes that we are playing in terms of financialization, where we are looking at a lot of high growth NBFCs. We are looking at capital market participants like stock exchanges, mutual funds, insurance companies, etc., where we believe over the next 25-30 years, as the savings moves from traditional non-financial assets into financial assets, you will see multiple drivers of growth for you to make money. The third thing that you will all notice when you go to India is the proliferation of SUVs, right? Every other car on any road in the Indian city is an SUV today. 5 years back, pre-COVID, 67% of all the cars sold in the country were Maruti. Today, 58% of all the cars sold is an SUV. Because what has really happened, and this is the psychology which Ashish also spoke about earlier, COVID actually gave us the fear of mortality. We started getting scared for our life. So what it did was, instead of us being on a path of savings, today we want to consume, we want to live a better life, we want to upgrade our lifestyle. Which is why, while the government spoke about housing for all, affordable housing in 2018, go to any city and tell me any affordable house which is getting launched. If you come to Bombay and read any newspaper, the number of deals which are happening of 200 crore, 300 crore, 500 crore is much higher than deals of 25-50 lakhs which is happening. So essentially, consumption has become premium. Now imagine when I started my career in 2000, consumption used to mean FMCG, biscuits and shampoos and soaps. So the theory was, as your per capita income kind of grows, you will take bath with a liquid soap. Let's say 25 years back my salary was $1,000, today let's say 10 lakh bucks. How many times do I take bath with that liquid soap? It remains the same, right? But I have a higher propensity to spend on better clothes, travel, bigger house, bigger car. And this is the single biggest structural change which the COVID has brought about. And this is going to be the biggest beneficiary for us to make money out of. So consumption has become premium. So branded clothes, branded products, lifestyle products, luxury developers, name it, have seen phenomenally high numbers being thrown at you from a growth perspective. So in the last 5 years, BMWs and Audis have had phenomenally higher numbers than a Maruti. And that is a small example that I want to leave it out here with. Then of course, we talk about, while we talk about India being a very young country with the average median age of about 28 years, the cohort of 65 years plus is also likely to double. And again, going back to my theory of this whole psychology of the mortality fear, we would want to be treated by the best of the doctors. I have been an NRI in Dubai. I was working with HDFC Bank a couple of years back, and I'm sure you will all agree, anytime you have a dental problem, you will go back to India. You don't do it here, right? And that's my experience, that's 100% right every time. So today, even for a bypass surgery, any elective surgery, anything which is not life-threatening and an emergency, you would plan it in a way that you go back to India and get it done there. I'll give you a small number on how this becomes a wealth creation opportunity. All of us know about Apollo Hospital. There is a small matrix called average revenue per occupied bed per day. For Apollo Hospital, about a quarter back, this number was 58,000 bucks. You and me, sir, can stay in Umaid Bhawan Palace Hotel for that price for a night. But this is what a hospital bed is charging per day. And occupancies are 80% plus. So imagine a hospital which is now professionally run is also became an opportunity for us to make money out of. These revenues were not there 5-6 years ago. Medical tourism coming back. Bypass surgery in the US costs about $2.5-3 lakh, $15,000-16,000 in India. Another $15,000-16,000 you can have a recuperation done in a 5-star hotel also. That is the opportunity to make money. With me on this? So when you look at valuation, somebody says, and I showed you the chart earlier, historically, if I could go back, this is a 10-year average of a mid-cap index at 17%. A lot of these industries which I just mentioned, the sectors which I just mentioned, were not part of the index 5 years back. So what is the sanctity of that long-term average, where you have a lot of new sectors, a lot of new companies, which are actually growing much faster than the index. So don't look at number, or a investment decision should not be taken basis the valuation alone. You should look at what is the growth. Ashish again mentioned about why last decade US was the best performing market. From 2010 to 2020, US had the best performance because the companies on an average grew by about 13 to 15%, which is the largest stock in the world today in terms of market capitalization. Their growth rate last quarter was 144%. The last quarter revenue was $18 billion. Who knew Nvidia 5 years back? Nobody, right? I've got a company in my portfolio, I can't name the company of course because of regulatory requirements, which makes parts for Chandrayaan. I can't name the stock, sorry. So we have a stock which makes components for Chandrayaan, and Chandrayaan landed in the moon last year at 120 at the cost of what NASA does. We have companies today which are actually competing with the Taiwanese companies for making semiconductors in India. We have companies in India which actually makes the printed circuit boards on which every smartphone, mobile, tab, everything actually operates out of. None of these were there 3, 4, 5 years back. So when you talk about a historical average, if you have new segments of growth emerging, taking decisions based on historical numbers, like they say, don't drive looking at the rear view mirror, is a big fallacy. So it is our view that while the general outlook for the market is that markets could remain sideways in a broader sense, this is a stock picker's market. If you get your sectors right, if you get the themes right, if you get your stocks right, you can make more money than what the index has delivered historically. So I have a lot of charts, I don't want to bore you with all that at the fag end of the day, but just remember this one thing, markets will always follow earnings growth. The only truth in the equity market investing is follow the earnings. Like a lot of crime thrillers, you say, no, follow the money. Who benefits from that murder? Here in equity investing, it is who makes money in terms of earnings. And if you see historically, only when there has been a revenue growth, you have seen the stock price also deliver, which can be seen from this chart. This is what Ashish was referring to earlier. So between 2008 and 2020, earnings grew by about 4%. So markets were flat, they did nothing. In the golden period of Indian markets between 2003 and 2008, the India shining story of Mr. Vajpayee, Nifty went from 1,100 levels to 6,300 levels, which means a 34% CAGR, because the earnings grew by about 24%. So follow the earnings, be in sectors which are likely to benefit in the future, and that is where you make money. How many of you invested in Infosys in the 90s? We all invested in Infosys after it became Infosys in the late 2000. But person who invested in Infosys, and here says Mr. Naramurthy's driver, he became a crorepati because he had the stocks of Infosys from 1990s. Who invested in ICICI Bank or HDFC Bank in 2000? We all invested after they delivered a 20% CAGR growth. Equity market is not about driving, looking at the backward, what's happening behind you. HDFC gave you compounded 20 years for 20 years. Yes. Will it give you compounded 20 years, 20% for the next 20 years? So who's the next HDFC, who's the next Infosys is from some of the sectors which I mentioned here. Right? And look at this. This is a projection of the, on the extreme left-hand side of the chart, of the large cap, mid cap and the small cap. People say small cap mein rally ho gaya, mid cap mein rally ho gaya, we don't want to be invested there, large caps has got safety. At Motilal Oswal, we beg to differ here. The entire Nifty basket is likely to grow the earnings for the next 2 years by about 10%. Now, Nifty mein 34% is taken by banks and financial services. You have another 12 to 13% of IT there. which means 50% of your Nifty index is likely to grow at 6 to 8%. Balance is oil and gas, Reliance and all those guys. So total average is a 10% growth for the Nifty companies. Compare this to some of the mid-cap index, which is likely to grow at double that clip of 20%. And small cap, of course, will have a 17-18% growth. And India is an emerging country. Since the day I started learning, we have been a developing country. We haven't developed yet. But haven't we grown? So growth is in identifying some of these good, fundamentally strong mid-cap, small-cap names, which are likely to grow the earnings far higher than what the nominal GDP of the country is. So very short one. I don't want to really bore you with all that, and this is just a small reference. So traditionally, when we all started investing, look at the left-hand side chart. These are what we call as the old economy sectors. Look at banks, look at ITs, FMCG, all growing at 4%, 3%, 7%. But some of the names which I mentioned here, and these are all delivered earnings. So 46% year on year, which is 40 times higher than what the index gave. So follow the earnings, returns will come. And that is my only bit about valuations. Everything else is relative. Earnings is what matters. That's the ultimate truth in investing. And if you get your earnings call right, भले ही 2-3% ऊपर नीचे हो जाता है, long-term effect of that earnings compounding at a fast, higher clip will give you phenomenally high wealth. So with that, thank you so much. I don't want to bore you. Just a small number here on what we can't even imagine. I wouldn't have believed when I started my career in 2000 that in my lifetime I'll see 3 lakh number on the Nifty. That's very simple. It just needs 12% compounded growth for the next 25 years. And it has delivered more than that. Right? So 1000 when I start my career in 2000 is 25,000 today. So I've seen one leg of my journey here. The next leg of the journey we'll all see together. So with that, thank you so much. And this is again what Ashish mentioned. Sorry, I'm taking a small Aditya on asset allocation. So this is a chart for last 25 years and goes back to my comment on why time in the market matters, not timing the market. So look at this chart for the last 25 years. I mentioned about Nifty growing from 1000 to 6300 levels. It saw 13 huge falls. Out of the 13 huge falls, look at the number of 27%, 30%, 60%, 28%. So these are 8 such huge falls. How do you time these things? You can't. It happens, it bounces back. Like COVID, Ashish mentioned. March 2020, Nifty fell from 12,500 to 7,500. Zoop, it went to 17,000. And trust me, I have a lot of investors. My experience plus your investment experience has been when Nifty in March, April onwards started moving back. From 7,500 it went to 10,000. Client said, थोड़ा सा गिरने दे 9,000 मैं invest करता हूँ. It went to 12,000. Investor said, let it come to 10,000, I'll invest. It went to 14,000. They said, 12 में डालता हूँ. It went to 15. They said, अभी छोड़ दो. Then they all came at 20, 21, 22, 23,000, whatever levels. Bulk of the investors, a lot of the youngsters have come into the market in the last 2-3 years. They've only seen one way of the market, and the biggest fallacy or the biggest crime that you can do is to be out of the market. I don't have the chart, but I will share it with the team of Wealthy Nivesh. So we have done a small study of if you're invested 100 rupees at the beginning of Nifty in 1991 and just forgotten about it, it would have become about 5,800 rupees. That is not the big number. The big number is, I'm sorry, I don't have the chart, very powerful chart. The story is, in that 30 years, if you had just missed the 30 best days of the market, I'll repeat myself, in a 30-year span, if you had just been out of the market in the 30 best days of the market, your 5,800 rupees actually falls to 2,100 rupees. So how do you time 30 days in a 30-year period? So आप कैसे time करोगे इसको? So best is to have your asset allocation model. Of course, you have partners who will help you design the portfolios, debt, equity, gold, silver, whatever, but stay invested. Stay the course, stay invested, because Indian markets will deliver phenomenally high returns, much, much, much higher than what we saw in the last 25 years. So out of my 1,50,000 crore that we manage at Motilal Asset Management, 8,500 crore of the promoters' money is only into the same equity scheme because they don't invest anywhere else. And they have seen phenomenally, they have become billionaires by doing just one thing. And my own personal example is the day Motilal ji and Ramdev ji get dividend, he calls 4 dealers and says कि कितने जल्दी खरीद सकते हो. They don't say कि कब खरीदें, say कितने जल्दी खरीद सकते हो. That is what makes money. Very difficult to time the market, very difficult to just look at one number and say valuation cheap hai, higher hai, expensive hai. Have your asset allocation plan. Look at companies in sectors which are growing at much, much, much faster clip than the nominal GDP growth, and you make your money. Thank you so much for that. Yeah, this is again one personal favorite. Sorry, last one slide. We have got 3 wars which are running, right? The biggest is of course the Palestine-Israel war. In Middle East, this became a big issue. Nobody wanted to invest because there was a war happening. But look at the Israeli stock market. The moment that war happened, September, November of 2003, the market zooped up. This is the Israel market. War is very, very, very good, unfortunately, for businesses. Very good for businesses. US became US because of supplying arms and ammunition to the warring countries. Started the World War II, right? So do not worry about these noises, they will come. Have your plans in place, keep investing. If you want to be little prudent, stagger the investments for a couple of months, but be invested. Thank you so much.